Well, Calculus Capital is probably one of the oldest established fund managers investing under EIS and VCT. We launched the UK's first approved EIS fund in 1999. I was one of the co-founders. The founders are still very much involved in the business. Our core management team has been together for over 15 years. Our area of focus in terms of investment has remained the same. We focus on more established, unquoted businesses primarily. And I think the fact that we have been in the market for over 15 years means that the advantages are we are very much in the flow of opportunities, but also we've refined our investment process over the years, and also our ability to manage and work with our companies and to exit by whatever means that might be. They are likely to be common to both, and I think whether an investor chooses to invest under EIS or VCT is very much a matter of which structure, which tax benefits work for the investor. But our investment policy will be the same for both types of funds. As I said, we focus primarily on more established unquoted companies. Our funds, we would always seek to have diversification. When we're talking about diversification, we don't just mean different sectors, but I think it's important to look to see that we have different drivers for those sectors. So, for example, healthcare, the drivers of healthcare would be an aging population, an increasing demand for healthcare and pharmaceutical services, not necessarily an improving aging, but not necessarily healthier population. So we're seeing great demand in that sector. Leisure, which is another sector that we favour. I think leisure could be regarded as more cyclically exposed, but in fact the areas that we favour, such as the fast casual dining sector, tend to be more robust through the economic cycle. And then, of course, if you look at something like business-to-business services, the drivers for business-to-business services are large companies outsourcing non-core activities to specialist providers who are able to provide those services more cost-effectively because that's what they do, and also often will provide it using technology in order to provide it more effectively. So I think areas that we favour at the moment would be healthcare, would be leisure, would be business-to-business services. Another area that we are seeing increasing opportunities in is the environmental services. Well, I think the common themes would be that they are more established companies. They've already developed some traction in the market. They will have a management team in place. They will be revenue generating. They may well be profitable, or certainly we can see the path to profitability. And that they still have considerable growth potential. So I think those are the common factors. The sectors may be different, and I think it's important to have diversification in a portfolio. I think one doesn't want an investor's portfolio to be too focused on one particular sector, which may itself be focused on one particular driver for that sector. And I think we would always aim to work with those companies. The companies themselves whether they are environmental companies, whether they're business to businesses, many of their challenges will be the same. They are about getting further traction in the market, rolling out their plans, gaining customer base, etc. So I think businesses may be different. You often find with business at this stage that there are some very common challenges, and I think we are experienced at working with them. I don't think we have a preference. I think we're agnostic so long as we think it meets our criteria and that we can see how we get to profitability, because obviously profitability is the end goal of all companies. I think virtually all of our companies will already be good revenue generators, but with far more to go in the market. Some will be profitable or profitable at EBIT level, but it's not a prerequisite for us. The important thing is, what's the business, what's the opportunity, what do the competitors look like, how good is the management team, and whether it's profitable or not. It's obviously attractive if it is already profitable, but it's not a prerequisite for us. Exits probably are the thing. I mean, in terms of whether one is investing under EIS or VCTs, without exits, there is no product. And we are very experienced in exits. I think we've had well over 20 to date. Those exits have been by a variety of forms of exit, whether it is trade sale, whether it is an initial public offering, usually on the alternative investment market, whether it is sale to a larger private equity company with the management wishing to take that business on further. The three companies we've exited recently, one is called Human Race. It provides participative sport in the community, things like triathlon, cycling, events. And we have just sold that to the owners, the French company that owns the Tour de France. And it's actually a natural fit with them. So that's a company that we have sold via a trade sale to a very high profile acquirer. And in fact, I mean, we were intimately involved in that whole process. Yes, we had advisors and we had lawyers, etc., but we were intimately involved in the whole process, from initial contact through to final meetings to sort out last minute points, etc., finalization of documentation. Another company that we have at the moment, which people may be aware of, they may see it in the high street, which we have not exited, but it's already in our thinking, is Chopped. Chopped is the healthy salad bar chain that's targeting the healthy end of the fast casual dining market. We are supporting them in their rollout in London. But interestingly as well, we're also supporting them in their rollout in major cities elsewhere in the UK. And one of the things that was very attractive to us when we looked at this was that, whereas, for example, prices are about 15% below London prices if you're in Manchester or Liverpool, property prices are 50% below. So obviously you can see the attraction for the bottom line in that. So we are working with CHOP to roll out their offering. We recently exited Horizon Discovery, a very different company again. Horizon Discovery makes the scientific products that the big pharmaceutical companies and the big life sciences companies use in their own research. They're not doing the research as such. They provide the tools that those companies need to do their research, and particularly in the area of genomics and gene editing. And to give an example of what we mean by genomics, for example, the approach to treating macular degeneration now in older people is based on gene therapy. Gene therapy is a very key area of research by the big pharmaceutical companies. Horizon Discovery provides the tools that they need to do their research. We recently exited that by placing our shares with institutional investors after a very successful initial public offering on the AIM market. The other investment we had very recently was Metropolitan Deposit, which has safe storage facilities around London, which we sold our stake to a financing group put together by management who wished to take it on to another further level. So I think that shows We're very experienced in terms of all forms of exit. Also, it shows the diversity of the companies that we're invested in, but I think probably gives a little bit of thinking behind some of our strategy about why we focus on what you would call the more established unquoted companies. And I think, one of the things about the more established unquoted company sector is one of the reasons why we're in it and why we've focused on that and refined our focus and our processes over the years is we feel that has the right risk return for investors. We are not an investor that seeks to shoot the lights out because we are experienced enough to know that if you seek to shoot the lights out in terms of returns, the majority of those investments will fail. Well, I think you can't have been in business for as long as we have and have been as active investors as we have. We've had many successes, but we will inevitably have disappointments along the way. Somebody said to me recently, you may have heard it too, that good judgment is based on experience, and experience is based on bad judgment. Now, whether we've had bad judgment in the past, I think sometimes we have made misjudgments. If you said to me, what's the main area where we may make a misjudgment, and that is in attributing to a management an ability to roll out their plan, which wasn't in fact there. And it's always important when you have a disappointment to analyze it and to bank that lesson and make the best of it. And I think one of the things that we have done over the years is we've always had a very intensive investment process. It can take 4 to 6 months to make an investment, and we have very detailed commercial due diligence, financial due diligence, legal due diligence. We now have very detailed people due diligence. We would have people who assess the capabilities not just of individual key managers, but also the ability of a management team to work effectively together. So I think that's one of the ways in which we have banked our lessons along the way, learned from them, and improved our processes going forward. That's a very good question. I think we have been doing what we do for a good many years. We have delivered returns to our investors. We have a very high profile in the market. We are multi-award winning. But I think the one thing that I would point to that gives me perhaps most pride is that it's wonderful to have somebody invest with you once, but we have investors who have invested with us on multiple occasions. And in fact, it's true to say that investors who were investors in our very first fund going back to 1999 are investors in recent funds. So I think if there's one thing I would point to, which I take great pride from, which I think shows our ability to do what we do well, do what we do effectively, and deliver returns to our investors, it's the fact that we have a very high percentage of investors who are repeat investors. And I think that's probably the best endorsement of Calculus Capital that I could give you.